The buy now, pay later stocks taking a hit today. The Consumer Financial Protection Bureau opening an inquiry into some of these names. CFPB Director Chopra saying buy now, pay later is a new version of the old layaway plan, but with modern, faster twists where the consumer gets a product immediately but gets the debt immediately too. The agency is looking to warn the public about risks. We are joined now by Mizuho analyst Dan Dolev, who was raising the red flag on this trade earlier this week. Dan, welcome back to Fast. Great to have you with us. Are you concerned that any regulatory action will happen that will impact the space?
Yeah, I mean, thanks, Melissa. It's always great to be here, and thanks for the mention. Sorry, earlier this week on our note. I appreciate it. Look, I think that this is something that, even though we didn't kind of expect it to be this week, we kind of, I feel like I'm not surprised to see this, because whenever there's consumers, whenever there's debt, whenever there's loan, whenever there's money, and there's the potential for consumers being, getting sort of the short end of the stick, I think that's where the CFPB actually gets involved. So yes, I mean, I think while I didn't expect this to be as soon as we thought in terms of like our note, I'm not completely surprised that this is actually happening and the CFPB is looking into this space.
I mean, this group has been a target. House Financial Services Committee had some hearings on this group and buy now, pay later in general last month as well. So it's not a complete surprise that there are some concerns when it comes to the consumer, Dan. But walk me through your concerns about the space in relationship to the valuations these stocks have, because you have this regulatory overhang issue at this point. And then what you outlined in your note, which is the delinquencies. For a lot of these stocks, they don't actually carry the loans on their books per se. So I'm wondering where you see the risk to the valuation in rising delinquencies. Is it that these buy now, pay later firms ratchet back the amount of lending so the growth won't be there?
Exactly. I think you exactly. This is exactly the issue. What we worry about is that it's sort of like a catch-22, right? If they continue to grow really fast, sometimes the delinquencies have to rise because they are letting more people borrow. Sometimes people cannot borrow. But if they want to harness the delinquencies, they actually have to slow down the growth, and then the stocks are not going to work. So I feel like it's kind of a strange situation where I'm not saying it's either or, but I'm saying that risk is now on the table, that you might be facing some of these kind of decisions over the medium term. If the survey work that we've done, which shows you that people use multiple apps, they're borrowing across multiple apps. 53% of people actually have defaulted or have missed a payment. So if this is actually going to come true, I think some of those risks might be more realistic in the medium than they're now.
Hey, Dan, it's BK. So I'm curious, let's look through this scenario here where you're talking about, and rightly so, and it seems that the market is validating what your analysis is. At what point does this turn around? What, as an investor, do I look for to say, all right, this is completely washed out and we're actually maybe going to start growing again?
I mean, look, the good thing about FPB is it's a good and a bad thing. The thing is it's going to take time. I think they don't have to give the data until March, and then it's going to be a process. But I think let's talk company specific. So the reason we like the firm is because, remember, a firm, I would go on a company specific thing, not an industry thing. For a firm specifically, remember, they have an exclusivity with Amazon that's, for an entire year. So I think you're going to get some sort of a massive amount of volumes coming in through the door starting, next year, which is, none of it is in consensus. So I actually think that despite all this noise, a firm could actually do really well next year because numbers are going to move up, right? Same thing for, Square or Block and Afterpay. That's all incremental revenue for Afterpay on Square or Block. And I think that those two stocks are going to continue to do well. I mean, I don't cover the other names, but I would be more worried with some of the smaller names where, it's a function of being too small and maybe not getting enough traction and losing share. But those two names specifically, despite the headwinds, I still think are very good buys heading into next year.
Last quick question, Dan, and that is, this is a relatively new industry, and so I'm wondering, how do these stocks do in a rising interest rate environment? And I'm not talking about the valuation part of it. I mean, I think we sort of understand what happens to valuation in a higher interest rate environment. But in terms of the lending portion of this, the actual business, do consumers do more buy now, pay later as opposed to using a credit card if interest rates go higher? Or how does that work?
I think it's a great question. We don't know, right? The answer is, Melissa, we don't know because we've never had this industry. and we've never, this industry emerged in a low interest rate environment. The one thing I can say is what's interesting here is that, remember, if you're doing a paying for, they're capping their revenue, but when they're borrowing money somewhere else, they might have to pay higher interest rates. So it's actually not necessarily a good thing. But for those interest-bearing loans, which a firm has a lot of, they can actually probably increase those rates as interest rates rise and actually protect their spread. So I think for a firm which does a lot of these like interest-bearing loans, that's actually not a bad thing. It's probably a wash.
All right, Dan, great to see you. Thank you. Dan Dola of Mizuho. I think that's a key point here. This entire industry, a lot of fintech, in fact, Dan, has not existed in an environment that isn't a 0% interest rate environment.
Yeah, well, it's funny, Mel. I'm sitting here looking at my text. Our friend Danny Moses is like blowing me up, screaming me at me. These aren't fintech companies. They're lenders. I'm saying it in his voice right now here, right? And so to your point about that different interest rate environment, these companies were born at a different time. They're being valued as fintech companies, and really they're probably lenders. And I guess what I would extrapolate it a little bit and say, what is this really saying about the consumer right now? We're seeing Block, Square paid $29 billion for Afterpay. We saw the deal that Amazon just did with Affirm, where they basically take no risk. PayPal made a similar sort of investment, I think, in Japan, and it just speaks to maybe the fact that we're seeing weaker retail sales, we're seeing credit card transactions decline right now. I'm not saying that this sort of action is specific to the retail environment right now, but it seems a bit subprimey at the moment.
I mean, Dan's note also highlighted the fact that many people who use buy now, pay later actually layer the loan. So they've got a lot of buy now, pay later going on. And by the way, when they run those credit, they're not tapping into your credit report. So they don't know what other loans one might have, whether it be a car loan or a mortgage or whatever it is, when they're extending that buy now, pay later loan. Guy, this nothing can go wrong, right? All good here.
You're so in my head. I was just about to say, yeah, that sounds good. What could possibly go wrong with that? Everything could go wrong with that. It's amazing how what's old is new again. I mean, and we touched on this a number of times. In terms of the stocks, because I don't want to necessarily wax poetic here, I do think PayPal put in a short-term capitulatory bottom in early December. We've talked about that. That 179 low makes sense. It's 185 or so now. I think if you're looking for a name that's probably getting unjustly beat up now on these headlines, I mean, PayPal took its medicine a couple months ago with the Pinterest and the subsequent quarter. I think PayPal looks interesting here.